Good evening. We begin tonight with breaking developments from the global commodities markets, where precious metals experience dramatic price swings that have captured the attention of investors and analysts worldwide. Gold and silver, two assets traditionally viewed as safe havens during periods of economic uncertainty, saw sharp declines on Friday, marking a sudden reversal of what had been a remarkable rally throughout the current year. The moves came amid broader turbulence across financial markets, raising questions about the sustainability of recent gains in these key commodities. Gold futures closed the trading session on Friday with a 9% decline, settling at $4,800 per ounce. This represented a significant pullback from the elevated levels the precious metal had reached earlier in the week. Silver experienced an even more severe correction, tumbling more than 20% in value during the same trading period. These dramatic price movements occurred against the backdrop of widespread selling pressure across equity markets, with major stock indices all posting losses for the day. The simultaneous decline across multiple asset classes underscored the heightened volatility that has characterized recent trading sessions. The sharp reversal in precious metals prices comes after both gold and silver had posted substantial gains in recent weeks and months. Market participants had been closely monitoring these commodities as they climbed to impressive heights, with many analysts expressing concerns about the pace and magnitude of the advances. The sudden downturn on Friday served as a stark reminder of the risks inherent in markets that have experienced rapid price appreciation. Investors who had positioned themselves to benefit from continued strength in precious metals found themselves facing significant losses as the rally came to an abrupt halt. Financial experts have been offering their perspectives on the recent price action, with several prominent analysts having issued warnings in the days leading up to Friday's decline. These market observers had noted that the velocity of the recent rally in precious metals had created conditions that could prove unsustainable. The combination of rapid price increases and shifting market dynamics had set the stage for potential volatility, a scenario that materialized with considerable force during Friday's trading session. The commentary from these experts provides important context for understanding the factors that contributed to the sharp reversal witnessed in commodity markets. Mike McGlone, who serves as senior commodity strategist at Bloomberg, shared his analysis on Friday, offering insights into the historical patterns that often emerge following rapid rallies in metals markets. McGlone pointed to historical precedents suggesting that when metals rise to elevated levels at the pace observed in recent trading, the year in which those gains occur can mark lasting price peaks. He specifically highlighted silver as a metal that may be particularly vulnerable to establishing a peak during the current year based on patterns observed in previous market cycles. His analysis suggests that the speed of recent price advances may itself be a warning signal for investors to consider. McGlone elaborated on the dynamics that can shift rapidly in metals markets, noting that while fundamental factors always provide justification for price rallies, the velocity of price movements becomes a critical consideration. According to his assessment, when prices rise as quickly as they have in the metals complex, market conditions that previously appeared to support higher prices can change with surprising speed. Deficits that may have underpinned initial price strength can shift rapidly, altering the supply and demand equation that drives commodity valuations. This observation speaks to the fluid nature of commodity markets and the challenges inherent in predicting their trajectory. Another prominent voice in commodity market analysis, Ole Hansen, who holds the position of head of commodity strategy at Saxo Bank, had issued cautionary remarks on Thursday, just one day before the significant price declines materialized. Hansen characterized the continued surge across metals, with particular emphasis on gold and silver, as entering what he described as a dangerous phase. His assessment reflected growing concern within the analytical community about the sustainability of the price trajectory that had been established in recent trading sessions. The timing of his comments, coming immediately before the sharp reversal, proved to be notably prescient. Hansen's analysis focused on a specific risk factor that he identified as particularly concerning in the current market environment. He pointed to volatility itself as a self-reinforcing phenomenon, creating a feedback loop that can amplify market instability. According to his assessment, as price swings become more intense and pronounced, market liquidity tends to diminish. This thinning of liquidity can exacerbate price movements in both directions, creating conditions where relatively modest shifts in supply and demand dynamics can trigger outsized price reactions. The concern he articulated speaks to structural vulnerabilities that can emerge in markets experiencing extreme volatility. Examining the year-to-date performance figures provides important context for understanding the magnitude of the recent rally and subsequent reversal. Gold prices, despite Friday's decline to $4,800 per ounce, had still posted gains of approximately 11% since the beginning of the calendar year. This appreciation occurred against a backdrop of currency market movements, specifically a weakening of the United States dollar relative to other major currencies. The relationship between dollar strength and gold prices represents a well-established inverse correlation, with gold typically benefiting when the greenback loses value in foreign exchange markets. The recent trajectory of gold prices had attracted considerable attention from major financial institutions, with some of the world's leading investment banks offering optimistic projections for the precious metal. Goldman Sachs, one of the most prominent names in global finance, had just last week established a price target for gold at $5,400 per ounce by year-end. This forecast represented a significant premium to current trading levels and reflected the firm's analysts' confidence in the ongoing strength of factors supporting higher gold valuations. The Goldman Sachs team went further in their analysis, indicating that there existed upside risk to even this elevated target. The potential for prices to exceed even the ambitious $5,400 target, according to Goldman Sachs analysts, stemmed from the possibility of increased participation from private sector investors. This assessment suggested that institutional and individual investors who had not yet established positions in gold might enter the market, providing additional buying pressure that could drive prices higher still. The emphasis on private sector participation as a potential catalyst for further gains highlighted the role that investor sentiment and positioning play in determining commodity price trajectories. However, Friday's sharp reversal raised questions about the timeline and probability of such scenarios materializing. The days immediately preceding Friday's decline had seen gold reach even more elevated levels than where it settled after the downturn. The precious metal had rallied past $5,500 per ounce on Wednesday, establishing a new high point before retreating. This advance occurred in the immediate aftermath of a policy decision by the Federal Reserve, the central bank of the United States. The Federal Reserve had announced that it would maintain interest rates at their current levels, declining to implement changes to monetary policy at that particular meeting. The decision itself, along with accompanying commentary from central bank officials, had implications for currency markets and, by extension, for dollar-denominated commodities like gold. Federal Reserve Chair Jerome Powell, who leads the central bank and serves as one of the most influential voices in global finance, provided commentary following the rate decision. However, his remarks did little to arrest the decline of the dollar in foreign exchange markets. The continued weakness in the dollar provided support for gold prices in the immediate aftermath of the Federal Reserve meeting, contributing to the push above $5,500 per ounce. The dynamic illustrated the close relationship between monetary policy expectations, currency valuations, and precious metals prices. Market participants parse every word from central bank officials for clues about future policy direction and its implications for various asset classes. Robin Brooks, who serves as a senior fellow at the Brookings Institution, offered his interpretation of the market dynamics at play before gold's sharp reversal on Friday. Writing in a note on Thursday, Brooks characterized the strong conviction among market participants regarding the continuation of dollar weakness as a significant factor supporting gold's advance. He described what he observed as high conviction levels in what traders refer to as the dollar down trade, indicating that investors had positioned themselves with confidence that the greenback would continue to depreciate. This positioning had important implications for precious metals markets. Brooks further elaborated on the mechanism by which dollar weakness was amplifying gains in gold, using specific terminology to describe the phenomenon. He referred to the weak dollar as supercharging the debasement trade, a phrase that captures the relationship between currency depreciation and investor flight to alternative stores of value. The concept of the debasement trade relates to investor concerns about the purchasing power of fiat currencies and the corresponding appeal of hard assets like precious metals. When a major reserve currency like the dollar weakens, investors often seek protection by allocating capital to assets perceived as maintaining value independent of government monetary policy. Gold has historically served this function. While gold captured significant attention with its 9% decline on Friday, silver experienced an even more dramatic reversal that underscored the heightened volatility in precious metals markets. Silver, which had reached levels above $120 per ounce before beginning to retreat from those heights, was trading at approximately $87 per ounce by Friday's close. The magnitude of the decline, exceeding 20%, represented a severe correction that resulted in substantial losses for investors who had established positions near recent peak levels. The steeper percentage decline in silver compared to gold reflected the greater volatility that typically characterizes the white metal's price behavior. Despite the sharp pullback experienced on Friday, silver's year-to-date performance remained impressive when viewed from the beginning of the calendar year. The precious metal had still posted gains of roughly 28% since January 1st, representing a substantial appreciation that had rewarded investors who had maintained positions through the rally. This performance followed what had been described as a stunning rally during the previous year, establishing a pattern of strong gains that had attracted considerable attention from both investors and analysts. The cumulative advance over this extended period had pushed silver to price levels that prompted questions about sustainability. Analysts at J.P. Morgan, one of the largest and most influential financial institutions globally, had addressed silver's price trajectory in commentary issued earlier in the month. Their assessment acknowledged that silver prices had already significantly exceeded the forecasted averages that the firm's commodity analysts had established in their models. This divergence between actual prices and projected levels indicated that market forces had driven valuations well beyond what fundamental factors alone might have supported, according to the bank's analytical framework. However, the J.P. Morgan analysts also acknowledged the inherent difficulty in identifying precise turning points in markets exhibiting extreme momentum. The J.P. Morgan team specifically noted that calling a top in markets displaying what they characterized as near parabolic price momentum was close to impossible. This choice of language, describing the price trajectory as near parabolic, conveyed the exceptional nature of silver's recent advance. A parabolic price curve represents an accelerating rate of increase, where gains become progressively larger in shorter time periods. Such patterns have historically proven unsustainable over extended periods, eventually giving way to corrections or reversals. However, the timing of such reversals remains notoriously difficult to predict with precision, as the J.P. Morgan analysts acknowledged in their assessment. The sharp declines in precious metals prices on Friday did not occur in isolation, but rather coincided with broader weakness across financial markets. Major stock indices all posted losses during the trading session, reflecting a general risk-off sentiment among investors. This simultaneous selling pressure across multiple asset classes suggested that factors beyond those specific to precious metals markets were at play. When both equities and commodities decline together, it often indicates broad-based deleveraging or a shift in overall market sentiment that transcends individual sectors or asset categories. The coordination of these moves added to the sense of uncertainty pervading financial markets. The volatility witnessed in precious metals markets has important implications for companies engaged in the extraction and production of gold and silver. Mining companies, whose profitability is directly tied to the market prices of the metals they produce, saw their share prices decline in sympathy with the underlying commodities. Gold and silver mining shares fell following the sell-off in precious metals, reflecting investor recognition that lower commodity prices would impact the revenues and earnings of these producers. The relationship between commodity prices and mining company valuations is well established, with equity prices typically exhibiting even greater volatility than the underlying metals themselves. For investors who had positioned themselves in precious metals or related equities, Friday's price action served as a stark reminder of the risks associated with assets that have experienced rapid appreciation. Markets that rise quickly can also fall quickly, a principle that was demonstrated with particular clarity during Friday's trading session. The experience highlights the importance of risk management and position sizing, particularly when investing in assets known for their volatility. While precious metals have historically served as portfolio diversifiers and stores of value, they are not immune to sharp corrections, especially following periods of rapid price appreciation. The events of Friday also raise broader questions about market dynamics and the factors that can trigger sudden reversals in asset prices. After sustained advances that had pushed gold and silver to elevated levels, a combination of factors appeared to converge to produce the sharp downturn. These factors included concerns about the pace of recent gains, warnings from prominent analysts about unsustainable momentum, and broader market weakness that affected multiple asset classes simultaneously. Understanding how these elements interact to produce volatile price action remains a subject of ongoing analysis among market participants and observers. Looking at the technical aspects of market behavior, the concept of liquidity plays a crucial role in determining how smoothly markets can absorb buying and selling pressure. As Ole Hansen from Saxo Bank noted in his Thursday comments, intensifying price swings tend to coincide with thinning liquidity. When liquidity diminishes, it means there are fewer market participants willing to take the opposite side of trades at prevailing price levels. This can create a situation where relatively modest selling pressure triggers disproportionately large price declines as buyers become scarce and sellers must accept increasingly lower prices to find willing counterparties. This dynamic may have contributed to the magnitude of Friday's declines. The role of currency markets in influencing precious metals prices cannot be overstated, particularly for dollar-denominated commodities like gold and silver. The 11% year-to-date gain in gold prices occurred in an environment where the United States dollar weakened against other major currencies. This inverse relationship stems from several factors, including the fact that a weaker dollar makes gold less expensive for holders of other currencies, potentially increasing demand. Additionally, dollar weakness can reflect concerns about United States economic policy or fiscal sustainability, driving investors toward alternative stores of value. The interplay between currency movements and commodity prices adds layers of complexity to analyzing precious metals markets. The commentary from Federal Reserve Chair Jerome Powell following the central bank's decision to hold rates steady had been closely scrutinized by market participants for any hints about future policy direction. While the specific content of Powell's remarks was not detailed in available information, their impact on currency markets was notable. The fact that his commentary did little to halt the dollar's decline suggests that his words either reinforced expectations of continued accommodative monetary policy or failed to provide the hawkish signals that might have supported the greenback. Central bank communication plays a crucial role in shaping market expectations and influencing asset prices across multiple categories. The concept of the debasement trade, mentioned by Robin Brooks from the Brookings Institution, captures an important investment theme that has gained prominence in recent years. This term refers to strategies employed by investors who are concerned about the erosion of purchasing power in fiat currencies due to expansionary monetary policies, government debt accumulation, or other factors that might undermine currency values. Precious metals, with their limited supply and historical role as money, represent traditional hedges against such concerns. When investors perceive heightened risks of currency debasement, they often increase allocations to gold and silver, driving prices higher. The weakening dollar had been supercharging this trade, according to Brooks's analysis. The forecasts and price targets issued by major financial institutions like Goldman Sachs carry significant weight in financial markets due to these firms' research capabilities and market influence. When Goldman Sachs analysts set a year-end price target of $5,400 for gold, such projections can influence investor behavior and capital allocation decisions. However, Friday's sharp reversal serves as a reminder that even well-researched forecasts are subject to the uncertainties inherent in market dynamics. The gap between the $5,400 target and Friday's closing price of $4,800, while not enormous in percentage terms, represents substantial value in absolute terms and highlights the challenges of precise price prediction. The historical patterns referenced by Bloomberg's Mike McGlone provide valuable context for understanding current market dynamics. His observation that rapid rallies in metals can mark enduring price peaks, particularly for silver, draws on decades of commodity market history. These patterns suggest that euphoric advances driven by momentum and speculative interest often prove unsustainable, eventually giving way to extended periods of consolidation or decline. While historical patterns do not guarantee future outcomes, they offer useful frameworks for assessing current conditions and potential risks. McGlone's specific mention of silver as vulnerable to establishing a lasting peak in the current year takes on added significance in light of Friday's sharp decline. The fundamental factors that initially supported the rally in precious metals remain a subject of ongoing analysis and debate. These factors typically include concerns about inflation, monetary policy trajectories, geopolitical tensions, and supply-demand dynamics specific to each metal. While McGlone noted that there are always sound fundamental reasons for rallies, his emphasis on the pace of price increases as a separate risk factor is instructive. Even when fundamental factors support higher prices, the speed at which those higher prices are reached can create vulnerabilities. Rapid advances attract speculative interest and momentum-driven buying that may not be sustainable once the pace of appreciation slows or reverses.